Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending June 16th, 2023. Looking at the market indexes for the week, the TSX, S&P 500, NASDAQ, Dow Jones, and Russell 2000 were all up for the week. Gold was up as well, and so was oil, up to $71 per barrel for the week. Due to the softer inflation data earlier in the week and the resilient economic data after the US Fed meeting during the week, the markets are rallying. Before I launch into the events of the week, I wanted to let you know that I have finished a new course. It is looking at stock analysis and evaluation from a dividend and value investing point of view. So please check it out on canadianmoneytalk.ca, and it should be some good value for everybody who's looking at individual stocks. Now, turning to Canada. Canada's population reached 40 million this week, a big milestone, and it's mostly thanks to immigration. Last week, Canadian employment data came in. The employment changes for May was a loss of 17,300 jobs, far worse than the 23,200 gain expected. This was made up mostly by full employment loss for May of 32,700 jobs, partly replaced by part-time employment increase for May of 15,500. The unemployment rate went up to 5.2%, also higher than expected. These numbers came in after the Canadian Central Bank increased its interest rate to counter inflation. One has to wonder if the jobs numbers, if it came out earlier than the interest rate decision, whether the bank would have stayed pat instead. Now for a little bit of bad news. Canadians now owe $1.85 for every dollar of their disposable income, with mortgage interest payments being the biggest driver due to the Bank of Canada's rate hikes. CERB payments, for those who received them in error, have also eaten away at Canadians' disposable income in the past year. There has been a 70% jump in interest payments from Q1 last year and Q1 2023, although most Canadians are on a 5-year fixed mortgage. House prices have also gone up in Q1 of 2023 rather than down, as have rents overall. Interestingly, some Canadians get and some lenders allow a significant amortization period, well over the usual 25 or 30 years, as in 70 to 90 years, thereby lowering the payments to the point of just paying the interest. The Canadian housing market picked up steam in May as buyers and sellers came to terms with higher interest rates. Seasonally adjusted sales were up 5.1% compared to April, the Canadian Real Estate Association reports, and increased competition helped push average home prices up 2.7% to $715,000. Sellers were more comfortable listing their homes than earlier in the year, with new listings jumping 6.8% overall. These numbers were collected during a pause in the Bank of Canada's rate hike campaign. Sentiment may have shifted after the central bank raised its benchmark rate last week. Turning to the United States, on Wednesday, the US Fed, quote, skipped an interest rate hike and stayed pat after 10 meetings of increases. The guidance was there would be 2 rate hikes by the end of the year, and we're expecting one in July, which is the next meeting. The market initially came down but recovered. The summary of economic projections released by the central bank revealed that most policymakers now expect the Fed's benchmark rate to reach a peak of 5.6% by the end of 2023, up from the previous projection of 5.1%, implying that at least 2 more quarter-point hikes are in the cards. Federal Reserve Chairman Jerome Powell stated that the central bank would consider the cumulative impact of the hikes when making future decisions regarding whether or not to implement further rate increases. In addition, Powell conveyed a positive outlook on the battle against inflation, noting that multiple factors are showing progress. The US also had its CPI read this past week, and it was positive overall. The core CPI for May, month over month, was 0.4%, and year over year was 5.3% increase, both as expected and better or equal to April. The headline CPI for May, month over month, was only 0.1% increase, and a year over year was 4%, lower than expected and much better than April. The headline CPI, which includes energy and food, was lower than the core consumer price index as those items stopped increasing. Real wages came in at negative 0.1% increases, which was much better than expected. This was a very good read in the US, showing inflation is coming off both consumption and salaries, which actually dropped. The markets loved it. The US continuing jobless claims were higher than expected at 1,775,000 and than the previous week. The initial jobless claims for the week were 262,000, higher than expected as well, and same as last week, continuing to point towards cracks in a highly resilient labor market. A mountain of credit card debt is piling up as Americans turn to plastic to counter their dwindling purchasing power. According to the Federal Reserve Bank of New York, consumers now owe a record $988 billion on their cards, up 17% from a year earlier, or about $5,700 per person. While the steadily rising figure took a break during the pandemic years, the number is causing renewed nervousness as it flirts with the fast approaching 1 trillion milestone. High inflation is pushing more consumers to put non-discretionary spending on cards, while others may be having a harder time paring back their lifestyles despite the price pressures. Interest rates are compounding the issue, with the average annual percentage rate now over 20%, making it a really costly debt for consumers. It's also higher than at any point since the Fed started tracking card APRs in 1994, contributing to the overall US household debt that topped 17 trillion in Q1. Quote, "The first few years of the 2020s have seen a number of acute economic, financial, and geopolitical disruptions on a worldwide scale, and it will take time for the ultimate consequences of these shocks to be fully felt." End quote. PIMCO writes in a new article called The Aftershock Economy. Quote, "Despite Fed tightening and bank collapses, it's still an astoundingly loose financial situation," end quote. And the credit card companies are the main benefactors. Now for some bits and pieces. The Chinese economy is slowing and there is deflation. The producer price index year over year for May was down 4.6%, more than expected and obviously deflationary. The Chinese CPI was up slightly at 0.2%, less than estimated. The Chinese central bank has cut interest rates in the past and again this week. The People's Bank of China lowered its 7-day reverse repo rate by 10 basis points to 1.9% from 2% for the first time in 10 months. The People's Bank of China also cut interest rates on its 1-year medium-term lending facility rate by 10 basis points to 2.65% for the first time in 10 months on Thursday. This will lead to China lowering the renminbi's value, which would cause Chinese goods to cost less, thereby China would be exporting its deflation. On Thursday, China also released a wave of lackluster data, including that the unemployment rate for workers aged 16 to 24% rose to a record 20.8% in May. Retail sales, industrial production, and fixed asset investments all grew at slower rates than expected. While China's Statistics Bureau said the data represented continued momentum for the recovery, it also acknowledged that certain international challenges could pressure the economy, but didn't elaborate beyond that. Oil prices fell more than 2% on Monday following remarks from Iran's supreme leader indicating openness to a deal with the West regarding its nuclear program, while concerns over China's fuel demand growth also weighed on the market. Energy stocks also retreated Tuesday after the price of WTI crude oil slid 4% to a 6-week low. China's reopening has come into question with the data coming from there, along with high oil inventories and decreasing population, which all show a lower oil demand for the future. The Chinese interest rate cut did increase oil prices, however, on Tuesday by 3%. The World Bank projects global growth to slow significantly from 3.1% in 2022 to 2.1% in 2023 amid the high inflation, tight monetary policy, and more restrictive credit conditions. The possibility of widespread bank turmoil and tighter monetary policy could result in an even weaker global growth and lead to financial dislocations in the most vulnerable emerging market and developing economies. Finally, looking at next week, we have still a few companies reporting next week. On Tuesday, we have FedEx to give you an indication of the economy health. On Thursday, we have Accenture, which is a big IT consulting company, Carnival Cruises for an economy restart, and of course, Canada's former darling BlackBerry. So we'll see how they're doing. Economic events next week. On Monday, we have Canada's Industrial Product Price Index, month over month as an inflation read. On Wednesday, we have Bank of Canada notes and meeting minutes. And Federal Reserve Chair Jerome Powell testifies on the economic outlook and recent monetary policy actions before the Joint Economic Committee in Washington, D.C. On Thursday, we have U.S. jobless claims, U.S. oil inventories, and on Friday, we have U.S. Manufacturing and Services Purchasing Managers Index, which are both good reads on U.S. inflation. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.